Hello and welcome. In this video, we will learn about two important topics which are risk to reward ratio and also risk management. Alright. Now, first let me start with risk to reward ratio. Let us assume that this much rupees is in your trading account. It can be Zerodha or Upstocks or Grow or any other trading account. The maximum risk per trade that you are supposed to take is 2%. Okay. Now what is risk per trade? I'll explain in few minutes. But the maximum risk per trade is 2%. It is not that you have to take 2% risk per trade. This is maximum, that's all. You can take 0.5%, you can take 1%, or you can take 1.5% risk per trade, but the maximum should be 2%. Okay. The minimum risk reward ratio should be 1:2, meaning if you are ready to take a loss of 1 rupee, then you have to get a minimum of 2 rupees profit. If you are willing to take 5,000 rupees risk, then minimum profit should be 10,000 rupees. So that is what risk to reward ratio means. Now how does this work? What is the use of it? I'll explain everything in this video. Okay. But now let me show you a trade. This is daily chart of BEL. Price is coming down and we see a hammer. We place our stop loss here, we place our target here and take an entry, and the price moves in our favor. Okay. I'll take this and explain you how to take entry by keeping the risk per trade for some value. Alright. Now, this is the same chart. So, price has come down and we see a hammer. Let us say that I am watching this chart from the morning, and at 3:20 p.m. I decide or I assume that it will be a hammer. Okay. Now 3:30 is when the market closes. So at 3:20 I feel that the pattern would be of that of a hammer. Okay. So what I do is I enter the trade here. So this would be risky trade because I do not have any price confirmation. Okay. I am just looking at the hammer and I am entering. So here is where I enter 188 rupees. Okay. Below the hammer is where I place my stop loss, and let us say the price is 181 rupees. Alright. Now my risk is 188 minus 181. 188 is where I enter the trade or where I buy the shares of this company. 181 is my stop loss. So 188 minus 181 is 7 rupees. So this is my stop loss and this is my risk. Okay, this is my risk. This is the risk that I am taking. Meaning I have entered the trade here. If at all the price doesn't move up but it starts to move down, this is the level where I will be getting out of the trade. Meaning this is the level at which I will be selling all my stocks or shares. Okay. Now this is my risk. So the reward should be minimum twice of this. So 7 into 2 is 14 rupees. So this is the minimum reward that I want in my trade. And only if I have this, I will enter the trade. Okay, only if I have this, I enter the trade. So minimum target must be 188, which is entry price, plus 14, which is my reward, which is 202 rupees. 202 is here. 202 is here. And our first target is much or way above that. Okay, 214. So we have a risk reward ratio of 1:2 here, and so we can enter this trade. Before entering the trade, we must do this and we must enter. It is not that after we enter the trade, we are calculating everything. Okay. First we look at this and our target and see if it is a minimum of 1 to 2, and then we enter the trade. Alright. Now let us look at safe entry. Instead of taking at the hammer, close of the hammer, I wait for one more day for a candle to form and close above the high of this hammer. So the price moves up and this is the candle that I get. And let us say on the second day at 320, I feel that the price will close above the high, and so I buy at 196 rupees. Okay, 196 rupees. Now I have to decide whether this is a good entry or not. Okay, I'm not buying. Okay, I'm deciding to buy at 196 rupees. Should I buy or not? Let us see. The risk here is 15 rupees. Why? Because I'm entering at 196 rupees. When I wait for price confirmation, the risk increases. So now it is 196 rupees minus 181 rupees. So 181 is 15 rupees. So the reward would be 15 into 2, which is 30 rupees. Okay, 30 rupees. So this must be the minimum reward, meaning our minimum target or the first target should be 196, which is this, plus 30, which is 226. 226 rupees, which is here. And our first target is way below that. And so the decision that I have taken to enter the trade is not a good one. Okay, I should not enter this trade because I am not getting a risk reward ratio of 1:2. Okay, so this is not a good entry. I should not enter this. It is okay if I enter here. Because I have risk reward of 1:2, whereas this here I do not have. Alright. Now let us say that I decide to enter here. I decide to take the risky trade. How many shares should I buy? How many shares should I buy? Is it 10 shares, 25 shares, 32 shares? How many shares should I buy? To answer this, we have to learn risk management. Okay, risk management. Let us say that your account, a trading account has 5 lakh rupees. And let us say that you decide the risk per trade that you are going to take is 0.5% of this account. Okay, so you have 5 lakh rupees. So risk per trade is 0.5%, which is 2,500 rupees. Now you must decide this before you enter the trade. Okay, and you can decide this to be any value between 0 to 2%. I told you that 2 should be maximum. Let us say that you decide for 0.5%. This is what I use. This is my risk per trade. Okay. Now, to calculate how many shares you have to buy, you have to divide risk per trade by stop loss. This is risk per trade and stop loss is 7 rupees, 188 minus 181, 7 rupees. And so this or these many shares should be bought by you. You have to buy 357.14 shares or 358 shares. And it is going to cost you 188 into 358, 67,304 rupees. Okay, 67,304 rupees. Now the question is, what is risk per trade? What is risk per trade? It is the maximum money that you are willing to lose if the trade that you enter hits stop loss. Okay. See, when you enter a trade, you do not know whether the price is going to move in the direction that you want or it is going to move against the direction. Okay. If at all the price moves against your direction, this is the maximum that you are going to lose, 2,500 rupees. Okay. and this must be decided by you. How much money are you willing to lose? Is it 3000? Is it 2000? Is it 2500? You must decide it. And after you decide it, you must calculate how many shares you have to buy according to this. Okay. So risk per trade divided by stop loss gives you these many shares. Now you pay this much and you buy these many shares at this price. If at all it goes down, if at all it hits the stop loss of 181 rupees, this is the amount that you are going to lose, and that's all. Okay, this is the maximum that you are going to lose. Alright, now let me calculate it for one more stock which has a different price here. Alright, so the price is moving down, and you see a hammer and you decide to take a risky entry. Let us say that you enter at 420 rupees and your stop loss you are placing at 400 rupees, and this is your first target. Okay, so it is a minimum of 1:2 and this is fine, but you have to calculate how many shares you have to buy. Okay, so let us do that. Let us say that your account has 5 lakh rupees. Risk per trade that you decide is 2500 rupees. Number of shares is risk per trade by stop loss. Stop loss is 420 rupees minus 400, which is 20 rupees. So this is your risk per trade divided by 20, and it comes to 125 shares. To buy 125 shares, you have to pay this much rupees. Okay, this much rupees. So you buy at this price, hoping that the price will go up. If at all the price comes down and hits the stop loss, this is the maximum that you are going to lose. That is what risk per trade is. Okay. Now, it is important that you keep the risk per trade same throughout your trading journey. It is not that you have risk per trade of 2500 today and you change the risk per trade to 3000 tomorrow, and you change the risk per trade to 5000 day after that, and you change the risk per trade to 1000 rupees after the day after that. No, it doesn't work like that. If that is what you do, then you are going to lose a lot of money if your stop loss keeps on hitting. Okay, you have to decide upon a risk per trade and you have to maintain this throughout your trading journey. All right. Now, how does this risk per trade affect your trades? Let me take an example. Okay. Let us say that you trade on 10 days. This is day number 1, this is second day, this is third day, this is fourth day, and you are buying different stocks. Let us say the trade that you take on first day hits stop loss. So your loss is this much. It is predefined, correct? Let us say that your trade that you take on second day hits the target. Okay, it's the target. And let us say it is 5000 because I am maintaining a risk reward ratio of 1:2. Okay. And let us say on the third day your trade hits stop loss. Fourth day your trade hits stop loss. Fifth and sixth day your trade hits targets. Seventh and eighth day your trade hits stop loss. Ninth it hits profit, it hits target. 10th it hits stop loss. Meaning out of the 10 trades that you have taken, only 4 trades have hit their target or reached their target, and remaining 6 trades have hit their stop losses. Even then, your account would be having 5000 rupees more money, meaning you would have made 5000 rupees even if 6 out of the 10 trades that you had taken failed to hit the target. Okay. Now, the accuracy of this is only 40%. The accuracy is only 40%, but still you are making money. This is because you are maintaining a risk reward ratio of 1:2 and you are fixing your risk per trade. Okay. Risk per trade on first day was also this. What was this? It was the same on this too. It was the same on third trade too, and so on. Okay. Remember that all the 10 days you have entered different, all the 10 days you have entered different trades. Okay. Here let us say you had bought Infosys shares. Here let us say you had bought L&T shares. Here let us say you had bought BEL shares and so on. Okay. All are different shares, but your risk per trade was constant and risk reward ratio was constant. Okay. So the accuracy that you need to make profit is 40% only. Now if this changes to 1:1, let us say that your profit and your risk and reward ratio is 1:1. And if out of 10 days, only 40% is the accuracy, meaning out of 10 trades that you take, if 6 trades hit their stop losses, 4 trades hit their targets, then still your account would be in loss. Whereas if you had maintained 1:2, your account would have been in profit. So this is where the risk reward plays magic. Okay. Now let us look at risk reward ratio of 2:1. Okay, 2:1. I'm not changing anything here. This is just to make you understand the concept. Let us say on the first trade you make a loss, 7th trade you make a loss, 8th trade you make a loss, and rest you make profit. Okay, meaning the accuracy is 70%. Meaning out of the 10 trades that you take, 3 are only the loss making, rest everything are profit making. But since the risk reward ratio is 2:1, your account would be in profit here only if accuracy is 70%. What does this mean? That means you are willing to take 2 rupees risk to make 1 rupee. Okay. So to win in this case, your trade accuracy must be 70%. Okay. So this is how the risk reward ratio and risk per trade plays crucial role in your trading journey. Okay. So make sure that you fix the risk per trade and also maintain a risk reward ratio of minimum 1:2. All right.